So,
Oh boy.
and we got the AI version. I think I saw that earlier. Yeah. Okay. All right. Let's take that away.
Oh, I can
Okay.
just see.
Excellent. Excellent. So a few people joined us already. Just wait for a few more. And just give it a couple of minutes and then we get started. Just get a few more peeps on board.
Good morning.
Good morning, Jakob. How are
Good
you?
morning.
I'm
Good
fine. What about
morning.
you?
Very good. Very good. So,
That's great.
okay. How many people got? So just one more minute and then we'll get started. I know we got quite a few people joining us this morning.
Ale z tych online to nic nie wynika.
Good morning.
Co chciałam powiedzieć? Niektóre są fajne, niektóre nie, a ona też myśli. Ona strasznie się napaliła na tą współpracę z Markiem. Nawet mi o tym Zoe mówi. Boże, nie Zoe, tylko Marcelina, bo jest pytanie, czy nie będziemy
Can you,
robić jakichś kursów
Natalia, just,
doszkalających
can you just
od niej strony.
mute your microphones, please?
Natalia, mikrofon.
Okay.
To wiesz, że
All right.
wtedy bym musiała być
We just thank you very much. Okay. Oh, we have Sabine from Asturias. It's somewhere I'm hoping to go to later this year. So, okay. So, very good morning, everybody. Welcome to our latest edition of the Credit and Collections Coffee Club. Shortly, I'll introduce our presenter today. I know we're in for an absolute treat. I'm really looking forward to this myself. When we ran through the slides in rehearsal a couple of times, I was really kind of blown away by what Brad's put together and what he's going to share with us in the next hour or so. So, just a little bit of housekeeping before we get started. So, today's coffee club is being recorded. It will be available to all of you, and indeed to all Callisto members. It'll be in our membership sections within a couple of weeks from today, so you'll be able to see it again, but only for Callisto members. If you want to, if you would like to see it again, please get in touch about our membership. Okay, so a quick question. We want these sessions always to be very interactive. So just to kind of kick off, I've asked you a question down the bottom here. What is your understanding of the Big Mac Index? So have you heard of it before? If you have, just share with us what is your understanding of it, and we'll get to the Big Mac Index in probably around about 30 minutes from now. So in the meantime, it's my absolute pleasure to hand over to the head of the Callisto Academy, Mr. Brad Morris. So it's all yours, sir. Take it away.
Thanks very much, Mark. Thanks everybody for taking the time to join this morning. I hope we're all caffeined up. And on that topic, I thought I would like to take us on a bit of a road trip about something pretty humble, something that we don't necessarily think about. But when you step back and listen to it, it probably makes a lot of effort. This does have application to what we're talking about later, because I do have a bit of a thesis that I want everyone to understand. You'll probably noticed in the news that the world isn't going to be getting uncrazy anytime soon. So it looks like we're going to have to be a little more understanding and appreciative of what is going on in the outside world. But in any case, I wanted to just start off with just having a look about the humble cup of coffee. Now, most of us, I'm assuming, are coming from an Eastern within the European sort of area. and not really known for its coffee growing agriculture. But I want us to think back. If you wanted a cup of coffee, you're obviously starting with the beans, but think right back to where that starts. First thing you're going to need is a viable agricultural sector. So you can get a tractor, but you'll also need other things like you'll need available labor, you'll need seeds, fertilizers, irrigation, property security, and then you've got to get it to the port. And to do that, you need a road network. And to do that, you need an automotive sector. And once you get it to the port, you need what's called marine port infrastructure. You can't just simply roll up on the beach and start throwing bags of coffee in place. And of course, all of these have their own sub-industries of funding, regulation, insurance, and maintenance. So now we get it to the port, you need a whole lot of infrastructure to get that. Again, think you are just trying to get coffee to the cup. But to do that, you need to have a suitable deep water port. You need to have navigation and navigation infrastructure. You need to have customs. You need to have storage and security. And you need to have shipping and handling, those huge cranes that you see. All of those things you need to get your coffee beans onto the ship. But we're not done yet. You got to get the thing from your port to the port of entry. And for that, we need a global maritime shipping industry, something that has basically been the backbone of humanity and international trade for several thousand years. To do that, you need a shipbuilding industry, you need maintenance, you need naval training and everything that goes along with that. You also need global radar and positioning. I mean, I'm just picking out a few top of my mind. If we dig deeper, there's probably a lot more in place that you need to have in, but these are just the top of mind ones. You can probably let your mind drift away at that. Again, this is just for coffee, just so it can do that. But once we get it to it, we've got to unpack it. You don't just throw huge Hessian bags of coffee onto the beach and hope a bunch of guys are going up. No, again, you need another deep water port, you need navigation systems, customs, storage and security, shipping and handling. You need all of those things to be in place just to get it to port. But we don't go down to the port to buy coffee. Next thing you need is a wholesaler distribution network. So you've got to have roads and utilities, you've got to have warehouses and property, and you've got to have forklifts and materials handling and adequate staffing. But we don't go to warehouses for that. You need another infrastructure to get it to your customers. You need a retail infrastructure. So you've got to have storefronts, utilities, properties, and staffing. And again, understand all of these stages have their own industries that support the funding, that support the regulation, that support the maintenance, that support the insurance. And those are just the ones that I could put in this PowerPoint. There's a whole lot more as well. And that's all so we can just get to this. And yes, that is me before I've had my makeup and I do my hair. But even when you get it at home, I mean, none of us are living off grid, or if you are, please tell me how, but you need electricity, clean water, sewage, and someone's going to make the cup as well. I say all this to say that everything everywhere is connected. When we start looking at words, you start hearing more and more. You've got the tariffs that are knocking on everybody's door, and everyone's worried about what that's going to do. You have got, you're going to start hearing more and more words like offshoring, nearshoring, friendshoring, reshoring. And this is what industries are we going to get back locally and what is going to be manufactured or done offshore, which is really, why is this a thing for us? Why all this talk about economics and global transactions, why is it a thing? Well, as you probably noticed, there's increased economic activity. There's increased globalization, more sophisticated supply chains. You probably remember the ship that got stuck in the Suez Canal, and that was costing something like about $10 billion a day in global trade. increased business and consumer demands. We just want more things, and we want more clever things. We want more sophisticated things. Those little rectangles that are in your pockets all the time, we want them to be shiny and to have more things that buzz and beat faster. And there's more competitive pressure about it. We've always got to have the newest and latest things, and industries and consumers are always trying to get to the next thing. Now, the other thing, of course, is that why is this a thing for us? We're just like administrators, humble credit officers, credit analysts, order to cash, collections people. With more and more complexity, we're being exposed in our day jobs more and more to what companies are like and how they behave. You will get an email at any time that could say, the collections process or the accounts payable process is no longer done in Shore, so it's no longer done in Hungary. It's been outsourced to India, or it's the collection process or the accounts payable process, which was once done by a UK company in the UK, has now been offshored to Tallinn or into Cape Town. This is happening more and more, and certainly when companies are buying and selling each other, this is going to happen. More so if you're going into other regions as well. Everyone's trying to expand. Their local markets are saturated. So even though right now you think, well, I'm not an economist, and I'm not an economist as well, nor do I, pretend to be one on television, but I am today. I'm going to give an idea of what that looks like. And the good thing is you don't need to have a degree in economics, nor do you have to have done a TED Talk, just to understand the basics and keep up with what's going on in the world and how to interpret the various signals. Now, I'll go through, and the other thing I'll just point out as we are going through this is that I'm aware that in this audience, and Esther, Mark, I'm not sure how many people are online, but I appreciate that everybody on this call is at a different stage of their understanding of economics. And for some of you, it'll be just simply replay the basics. For others, it will be completely new material. And again, trying to trying to get the understanding across to everybody so that they can appreciate what's baked into economic theory and what to do with it in your day-to-day. So if you look over on the left, for example, these are probably terms that you've heard and had to deal with. Inflation, yes, that can of beans, that loaf of bread, it's always going up. But interest rates, yeah, we've probably all got mortgages or credit cards, and we get that dreaded letter from the bank that says you're paying a little bit more for things. Unemployment, we're worried about our jobs. Stock markets, balance of trade, exchange rates, all of these things funnel into how they impact a national economy. And all of these things have different aspects within a national economy that they affect. For example, the political stability, the business environment, the financial and credit risks, all of these have some differing impact upon what you're looking at. And more importantly, and I really want people, I hope, to go away with this. What I want to do, and there's a few examples at the end, we'll get to the end, to say, all right, okay, Brad, I got all those indexes and all those fancy numbers, so what? I want to give you some idea of how you can look at these indices and think, right, I'm in a planning meeting this week with the commercial guys, and I've seen some news. This may impact us hitting our quarterly targets. This may impact me getting money from those invoices and fulfilling the accounts that have got outstanding. So there's a whole raft of things that it has a subtle impact of. And what I want to get everybody in with at least a very rudimentary understanding, at least, and forgive me if you're already aware of a lot of these concepts, is to say, what do I do with this? How does this number affect me? Why do I have to worry about it? Why do I have to do something with it? And how do I assess it going forward? So let's just move on with a little more of the bits and pieces. The fundamental economic indicators, effectively three kinds. And this is, if you just think of it as past, present, and future. Lagging indicators. What will happen is that governments will accumulate economic data, and it will report on the way things were. Very much like looking at the company results that you would see in an annual report. These are national results that you would see in economic reports. Coincident indicators, those are indicators that are happening right now, what it looks like right now, the state of numbers. And leading indicators are thinking, right, the next 2-3 years, what's coming up? So you might hear things like, expected GDP growth is going to be 2%. So that means in the next year or two, the economy is expected to grow by about 2%. That's a looking forward indicator. So let's just start with the basics again. Forgive me, I'm not trying to teach everybody how to suck eggs or how to do the basics, but for those on the call, this might be your first intro or a bit of an expansion. There's a lot of them. I will go through them at a bit of a pace. If you want me to stop, put up your hand, or there's Q&A, more than happy to slow down. Okay, so first one, no surprises here, stock market. This gives the best, probably, I suppose, the most easy and readily available indication of what economies are looking like. What are the leading companies' trading positions looking like? And there's so many, and there's so much information going into this at one stage that it becomes very, a very accurate reflection on what the state of the economy looks like. And it reacts very, very fast. I'm sure you've heard plenty of news articles to say the Dow Jones went down by 3%, or markets were in free fall after they heard Trump did a thing or something. The markets respond very well because there's trillions of dollars invested in these at anyone's times, and they're very fluid, very flexible. But the other thing is you can compare them year on. You can compare economies to economies, and a lot of times you'll have economists who like telling you that the FTSE, I mean, we get this all the time in the UK, that the FTSE has not performed as well as the US or Japan or other G7 nations. And a lot of political pundits do that to try to get some get some flair out of people. But again, that one's the most thing, and it's more an idea of a leading indicator. Although it's happening right now, because it's so volatile, it is also something that can quickly show you what tomorrow is going to look like. GDP growth. This refers to the forecast change in domestic output. GDP is gross domestic product, and it gives you an idea of how much more a country is going to produce. And it gives you insight to the economic health, standards of living, investment decisions, policy decisions at government level. And as we can see, for example, the UK, fairly flat, Italy, Germany, really struggling, probably not going to have much in the way for the next year or two. However, Poland and Turkey have got a little more of an optimistic outlook for this. And I think if I span out and look at the world at a higher level, areas like, China and India are just going, I think about 10 or 15%, if memory goes me correct. Inflation. If you've been to a supermarket, everything's getting more expensive. This is what it looks like. Now, even though it sounds like it should be an indicator that looks forward, it is actually saying how much things have gone up over the last X amount of years or X amount of time. Normally, these are done on a month-to-month basis, and it does give an indication of how much purchasing power has been effectively eroded, or how long, how much more you're paying for your bread, your eggs, fuel, and so forth. Unemployment rate. And again, this one's really interesting in the sense that a lot of countries, their unemployment rates are relatively stable. Usually they don't move more than maybe about a percentage, maybe about half a percentage point each way. I know the UK has been about 4.5 or something. Now, what that looks like in terms of outlook or go forward, it's what you've got to look for is there a spike in unemployment? If typically your country has had maybe 2 or let's say UK, about 4.5%, When that starts getting north of about 5.5, that starts to be a problem, because if you just follow the logic through, companies employ people to make stuff, or to make, or to do things. But they if they are not making things, or providing services, they're not selling. And if they're not selling, then they're losing what's going on in the economy. And the first things usually to go are headcount. I know actually, when I was speaking to Esther and Pavlina when you came over here, the cultures were quite different. The idea that in the US and the UK and some other Anglo markets, the ability to terminate people, to lay them off, to give them severance, is a lot easier to do in these countries than it is, let's say, to do in Eastern Europe. So that's another thing. But this gives you an idea. If unemployment's going up, means businesses aren't making enough and they're not selling enough. Again, a bit of a although it is could be used forward looking, it is actually considered a lagging indicator. Consumer price index. This is very close to inflation, but effectively it takes a basket of goods. This could be anywhere, depending on the economy, anywhere from a few hundred to a few thousand, and it will benchmark it at a particular point in time and say, how much has this basket of goods increased over that particular time? So in this particular case, this is the CPI, and it's saying that effectively, even though it doesn't look at that much, over the last 10 years, that's UK numbers, by the way, over the last 10 years, most consumer items have increased by about 35 to 40%, which is pretty big. As most of us can remember, about 10 years back, most of us still remember COVID, and that wasn't that far ago. But again, what happens here is that it is a lagging indicator, because it gives the idea of what were prices at a particular point, and then they benchmark that what they were several years ago. You can change that 100 to various scales. If you go on to the government websites that produce these, you can analyze those figures with a little more nuance. But again, that's as you can see, over the last 10 years, going up by about 30% is it's quite a kick. GDP per capita. This is effectively how much money or how much wealth each citizen has. Now, I know that's not private, but it's saying across the economy, this is how much, I suppose, national wealth they have a contribution of. And even though I've just given a few countries in Europe, I mean, for example, if you a few countries more in the Eastern European corridor and Central corridor, if you go to places like Switzerland or Monaco or Ireland, that becomes a lot bigger. That comes up to maybe about 120,000 per head. But it shows effectively how much wealth, not necessarily, not personal wealth, but sort of like national value each citizen has. And again, a lagging indicator, because it's looking at the amount that a country outputs divided effectively by its population. Interest rates, we've all felt these. And the reason this is a leading indicator is because it informs investment decisions. As you can appreciate, if you're looking at certainly longer term, like construction projects, housing, even long-term capital acquisitions like leasing or automotive, those interest rates get locked in fairly. Those interest rates are usually stuck for the term of the loan. So what you've got to understand is that how much the interest bill is going to be on a particular project. How much am I going to have to pay in interest to fund this particular project? Now, if interest rates go up, you're going to think, right, that's going to impact my cash flow. I'm going to pull back my investments, and it sort of takes the heat off the economy, slows the economy down. And it also, so it says, we're going to pull back how much money we're going to use on a long-term basis for expansion and so forth. Sovereign credit ratings. You've probably heard, excuse me, you've probably heard things like double A's, triple A's, double B's, and so forth. All of this is effectively saying how good the economy, how good that national government is in repaying its debt. For example, if you could put money, let's say, in US Treasury bonds or UK bonds, the idea of thinking, will the government repay my money back as an investor? It's highly unlikely there's going to be a problem. However, if you're going to put your money, let's say, in more, how could I put this politely, exotic economies, you have to be a very sophisticated investor because the economic profile of those countries when it comes to governments and infrastructures and other things that will go on here is a lot more complicated. Therefore, it covers a lot more risk. Russia, as you can see there, it's in the news. It's not a surprise, and it is really struggling on the world stage to get transactions going. And just to give you an idea, again, sorry if this is just teaching you the basics, but effectively what this is saying is that how much risk each one of these countries have. And if you can kind of do a little mapping in your eyes while I'm talking. You can think, oh, okay, yeah, US, Canada, Australia, New Zealand, most of Europe, pretty easy. A little bit of risk in the UK, a little bit more risk maybe in Spain and Portugal and China. Certainly a lot more risk when it comes to places like Russia, Argentina, so forth like that. Now, even that this one I struggle with a little bit because it's when you get a credit rating from one of these big credit agencies such as Moody's, S&P, they are in fact the gift that gives in 3 dimensions. So it's a bit cheeky. Whilst they use their assessment based on past performance of the country's economy and what it looks like right now, they also usually put in an outlook as well. So they'll say it's a double A with a positive outlook. It is a single A with a negative outlook. So in one sense, it's also a leading indicator as well. The good news is you can usually get these, even though there's a paywall on Moody's and some of these other rating agencies, usually you can glean it from news articles for free. Debt to GDP ratios. So this is how much debt the government has accumulated, how much it's borrowed versus how much income it has or how much value it produces every year. So let's say, for example, if only 30% of your national output is represented by debt, you've got a lot of freedom to make political decisions, make public investment, and bolster up your infrastructure. However, if you think of a country like a house or like a company as well, the more interest you have to pay, the more debt you have, the more interest you have to pay on that debt, and the more money that takes out from public services such as pensions, health services, national roads, infrastructure, police, all of those government organizations get impacted if the country is busy paying a high value in interest payments every year. And that is going to get more and more interesting, certainly in what will be certainly in the Western countries, as there is an aging population that is going to put more and more pressure on an already straining public infrastructure. So health services, community services are going to have more and more demands put on them. And because there isn't enough babies being born and a new workforce coming in to fill that at the back end, there's less money going into the pot. So places like Italy, South Korea, Japan are all going to struggle are actually struggling right now because of this aging population. That's a talk for another coffee club, maybe, Mark, but right now, this is what it's looking like here. Now, those were the more fundamental ones. I'll move on to ones that are a little more nuanced with assessing economics. This one's rather interesting. Logistics Performance Index. This is compiled by the World Bank, and effectively it is saying, how easy is it to get stuff into the country? And as you can see on the right, it does actually consider a number of data points, and it does it by looking at data in real time, and it also takes a whole lot of survey information from various sources, various industry leaders, various companies as well. So in one sense, it's saying, right, how easy it is, for example, to get stuff from the port down a roadway. How much bureaucracy and paperwork do I have to go through to get it into, from the port over to the point of sale? So that could be everything from a bag of coffee through to an MRI scanner, through to an aircraft engine, through to tools, all of these things. Now, this is just simply the movements required to get it through. I should have maybe blown this up a little bigger on screen. However, if you look at the countries in the dark blue in the bottom bottom left-hand corner, again, it shouldn't necessarily be a surprise. You've got the US and Canada. They've got a lot of they're on shore. There's big shipping lanes back and forth. You look at countries that, let's say, inland, no surprise there. Providing you've got decent navigable rivers, which is what you've got in most of Europe, you have the Danube, the Rhine, and so forth. They act as quite a busy artery to world trade, because you can navigate those waters with large ships and move vast quantities up and down those rivers, because it's cheaper to move things via river or via water on a sort of per ton basis than it is, let's say, via road. You're probably looking at Africa and thinking, well, there's a lot of water there. What's going on? There's a lack of deep water ports. And because there's a lack of deep water ports, you can't get those big ships in and out as easy as you can with, let's say, throughout the Asias and throughout Europe and the US. So that's something to keep in mind, but certainly something that, if you are into shipping complicated goods or complicated products throughout various countries or across land, this will give you an idea of how easy it is to get stuff in and out. Purchasing Managers Index. I think out of all the ones that I've seen, this is probably one of the most powerful. Think of it this way. Purchasing Manager is on the other side of your sale. These guys are the ones buying from you. The way this index works, it goes from 1 to 100, greater than 50, good, less than 50, bad. And what it's saying is that if it's less than 50, purchasing managers, and it's all taken by a survey, purchasing managers are planning to buy less and less things and take on less and less services. If it's above 50, it means that purchasing managers are a little more optimistic in doing so. Now, this is going to turn out, and I think even the best economic minds are still scratching their heads. But the Purchasing Managers Index and the optimism, let's say, with the new Trump tariffs that are coming out, ironically, it's still above 50. It's about 54, I think, in the US right now. And this is an index that's published monthly and takes into account things like deliveries, new order, how much employment is going to be made, how much production. But all of these are factored in, and it's done for both manufacturing goods and also the delivery of services. So that would be, for an example of that, would, let's say, taking orders of long-term service contracts for an IT or a telecommunications company. So this one here, and these are published. You can go to, we can get the links out for this later, but if you go to tradeeconomics.com and you simply type in Purchasing Managers Index for your country, it'll either be published, most are published monthly, a few are published quarterly. I think there's one or two that are published annually, but for the most part, the major economies will have this indication monthly. What it means to you is that keeping an eye on this will say, do I have to worry about adjusting my forecasts? Are we going to have more and more trouble making sales because clients are putting off investment decisions? Probably not so much with, let's say, perishable goods, fast-moving consumer goods, but certainly larger plant and equipment sales, heavy machinery sales. Those have certainly got a longer sale and purchase cycle, and it takes a little more thought and planning to do that. But again, I would say this one is probably one of the more significant. Moving on, Global Innovation Index. This is a bit of a slow index, but if you're moving into a new country or you're expanding into it, it effectively says every country has got inputs. And what I mean by that is it's got universities, companies, legal systems. It's got infrastructure such as the telecommunications network, broadcasting, roads, rail, these sort of things. Market sophistication, how accommodating it could be, business sophistication, how clever are the people in those buildings to do so, what are they like with, let's say, curiosity and developing and research and making things happen. All of those are put in to say, right, when we consider all of those, what comes out? So the easy places, and if in your mind you are thinking things like Silicon Valley or Cambridge or scientists hunched over the microscope trying to isolate the cancer-causing gene, that's exactly what we're talking about here. No surprise, of course, you've got the US and the UK leading innovators in development, or you've got to think of medical research, COVID. I think that the UK led the research in COVID development. The US, just think of all the computer technology that we take for granted right now. Singapore being a tech hub. No surprise there, and this is still a couple of years old. When do they publish this? I think they only publish this every few years because it's a relatively slow indicator. But I think there's no doubt China is going to screech forth in the next couple of years. The next time this is published, this is published in 2023. The next time this is published, I think you will see China probably overtaking the UK and the US in terms of innovation. So this is a bit of a slower index, but it gives you an idea of how receptive technology they are and how receptive to changes in innovation and development your country would be. Big Mac Index. I know everyone's been after that. Now, whilst there are some economists who basically see this as just a bit of fun for the undergraduates, it is a little more sophisticated than first comes to the eye. Now, pretty much every country I've been to, and I've been to quite a lot, I have tasted the Big Macs. They pretty much all taste the same. Okay, so the recipe for the secret sauce is fairly consistent. So therefore, the pricing should be consistent. But what this does is take into account a lot of local requirement, a lot of local pricing as well. So the US is the benchmark because obviously the home of the Big Mac. And as you can appreciate, Canada's a little cheaper. Mexico cheaper still. And this gets into how much the inputs cost to making a product that is standardized globally. So these come into things like beef prices, prices of wheat, the cost of getting that from the farm. Are they produced locally or do they have to go cross border? So places like South Africa and Taiwan, they've got very low cost of labor and they've also got abundant supplies to the raw materials, making it pretty cheap. You can get it, almost half price. You can get one for one in Taiwan. However, going to places like Switzerland, where everything is just super expensive, no surprise there, even though there's abundance of cows, prices of inputs such as labor, property, logistics, all inflate this. The other thing it does, of course, is shows disparity. If you really want to get into sort of the nuance of some of it, it also does show some level of disparity within the exchange rate, which is why Japan is so low, because the Japanese yen is performing so well against the US dollar, and this index is benchmarked in dollars. So again, a very interesting index to look at, also not just for tourists, but also if you're certainly if you're in the consumer goods market, this one becomes a very interesting benchmark to say, okay, how much money do people have in terms of discretionary disposable income? Transparency index. This is sometimes known as the corruption index. Trying to be, I suppose, polite about that, but effectively it evaluates how much openness and transparency and accountability governments have in various nations. I think New Zealand, Norway, and Denmark sit at the top of the list. No surprise, you see some countries such as Venezuela, who've always had trouble with the oil supply and various movements of government there. Some of the African nations, again, suffering from levels of corruption and lack of transparency. This is important if you're going to move into those markets, because in one sense, there might be a lot of opportunity, but there is also a lot of risk. This is where you've really got to keep your due diligence high. This is where you should be partnering with other agencies and brokers that are far more trusted. This is where you should be doubling up on credit insurance and making sure you've got monitoring in place, because it's tempting to go to these places and try to make the money, but there's also a big risk with those as well. And you've really got to know what you're doing going into those markets. Effectiveness. This is effectively, do you trust your government? I know we don't. Okay, I know you think they're all a bunch of blockheads running the country, but that's on a scale. Some are better at it than others. You'd look at, let's say, some of the Nordic countries like Iceland and Sweden, and Finland and Taiwan, very open. Switzerland as well, very open, very effective government. The country effectively trusts its leadership, getting down to other things such as, will the government support the court systems? What level of bureaucracies are in place? Public infrastructure, the roads falling apart, can buildings get permits? Can electricity lines get through? Is the water regulated so it's clean? We don't have so much that in the UK. That's a bit of a hotspot now. But what is the likelihood that there is going to be a consistent rule of law in those countries? Again, you can just do a little mapping in your own eyes and think, okay, your sentiment in that is probably well founded. You're probably thinking, oh, okay, yeah, that's pretty much the image I've got. And to end on an upbeat note, this is how happy we all are, aren't we? Real super happy. As you could appreciate, again, scale of 1 to 10, this influences things like customer behavior, productivity at work, social structures that are in place, rules of self-government, and so forth. I would probably contest that China is actually probably getting better at this. Right now, it's roughly, I think it's around about 6.5. I would think it's getting a lot better. But again, this is important to think when you're building brands and when you're moving into those sort of areas. what are we looking at in terms of the reception for consumers and businesses and governments in those? Do they have a lot more to worry about? If they don't have a whole lot to worry about, they'll probably be a lot more receptive to imports, but they'll also probably have a lot higher expectations as well. Now, as I said at the top of this, it's one thing for me just to keep throwing out all these numbers and, make you feel impressive and clever that you know what a GDP is and you can recognize it in its natural habitat. However, what do you do with it? You're going to have meetings. You're going to look at changes in targets. You're going to be looking at various expectations, collecting money from your clients, and making payment arrangements and so forth. What to look for? I've got these are just 4 examples. There's plenty of I could look at, but these are just 4 major industries and what these indicators look like on board for those. So we'll just go through those nice and quick. And again, for the Callisto members, all this is available. But take a screenshot if you want. Hey, do what you want. But let's try the automotive industry, for example. High interest rates, they affect the cost of borrowing and purchasing automotive parts. It's got a long sales cycle. So high interest rates are going to mean for higher borrowing costs, higher cost of capital. Exchange rates, getting parts in and out of various countries, you're going to hit that as well. Inflation, you're talking about rising of raw materials, cost of steel, cost of labor. GDP growth, this one's fairly common, you'll see. Whether or not whether or not there is enough, whether there is a line of sight to have the confidence to purchase such a large transaction, be that trucks or even a car for households or automotive fleets of transport companies. Again, if there's no growth, there's less things to ship, and there's less need for them to renew their fleet. And the Purchasing Managers Index, again, feeling that as well. Pharmaceuticals, again, inflation, exchange rates, all of these things because of the diversity of supply chains across borders, interest rates. Pharmaceuticals are very capital intensive business. So things like clinical trials and purchasing patents are very capital intensive. GDP growth, again, whether or not there's going to be increase in clients, to say there's going to be boost in healthcare spending. And this is really important. The debt to GDP ratio, very important for countries that have nationalized healthcare systems. As I said earlier, if you have a population that's aging, if you have an economy that's got a very big debt burden, it may mean that they have to start trimming healthcare spending as well, which has a ripple effect to the pharmaceutical companies, because there's just not enough money to spend in hospitals, and prescriptions that are sponsored by the state may fall through. So some drugs that used to be covered by a state by a state prescription are no longer, or they're harder to get, or there's longer waiting lists. Consumer markets, I'm talking about things that are, let's say, durables, clothes, that sort of thing. Again, let's take, for example, if unemployment's going up, you're not going to go out and buy that new set of shoes. Okay, Esther might, but you might not go out and buy that pair of shoes because you want to save money, because you're thinking, am I going to lose my job? Interest rates going up, less to spend on a new washing machine, more is required to spend on the mortgage. If there is low economic growth, then there's going to be a softening in how much discretionary income we will have to spend on these things. Exchange rates as well. I don't think there's much that is made in the UK. Everything is imported almost these days. So that is another factor that puts in. Beverage. Consumer Price Index is obviously the big leader here. If there is money to spare, then people will go out. If there's not, they won't. Again, things like unemployment. If you're worried about, if you're not secure in your job, if you're hearing that people are being laid off and you're worried, am I next? You're not going to be going out to fancy restaurants as much. Inflation as well. It used to be 20 euros for a meal out. Now it's 25. You're thinking we might just have to cut this back a bit. So I'm just going to wrap up here because we're getting close to the half hour. Mark, I'll hand it back to you. But any questions?
Yes, thanks, Brad. As I said at the beginning, I certainly found it fascinating, and there's so many different aspects to this. And as I put in the chat just now, that all these, the majority of these factors that you've been introducing to us today are all aspects that everybody who's here, their companies would have been looking at all these factors when choosing the locations for their shared service center, their manufacturing sites, and indeed if they're looking to move them. So these are not, all these indicators are not something that's done by somebody else somewhere else. These are real time factors, and as you said earlier on, I think some of these, like the purchasing power and so on, will be very much scrutinized deeply now when we're looking at the tariffs that's going on in the world right now. And it was in when we were saying last night, Brad, when we were running through this, we were talking about how quickly most of these indicators are updated, and you were saying the majority of them are like on a monthly basis. Yeah, so it's pretty quick.
Exactly. Yeah, exactly. So yeah, some of them and some of them more reflect the economic climate. Some of the slower ones will reflect the economic culture of a country. So, but yeah, every one of these will have some type of impact on a business, and I trust I was managed to explain that in some form.
Mm. And as I was looking at the transparency index, for argument's sake, and I remember I studied a bit of this at university. Um, there is a direct correlation between the sort of the color code you had on that slide. Perhaps you can just, yeah. I mean, for example, just um, I was looking. I think that's Uruguay in South America, the yellow country on the east side. It's Uruguay, I think. And yeah, and I know there's a very high level of shared service centers in Uruguay, for example, as opposed to, say, the neighboring countries there. So it's just a little sort of quick example of how this is how this kind of connects with so basically FDI, foreign direct investment. Yeah.
Yeah.
I was asking in the chat if anybody else is actually using any of these indicators. We'd appreciate your feedback. So are you aware of them? Are you familiar with them? And we've spoken a few times. We've done other presentations in the past with like Moody's, for example, where they've been describing how credit risk is now a lot more than just looking at balance sheets and factoring sort of various ratios on the financials. And many of these aspects will actually be brought into play when companies are looking to either purchase in terms of suppliers, and also look into who they're going to sell to and where. So as I mentioned earlier in the chat, I was saying that our roles, it really kind of are impacted by and impact all these indicators. And working in the credit O2C area, it's such a variable and volatile world, because all these aspects are at play, and it's our responsibility, whatever role we have within the O2C cycle, to ensure that we are the best that we can possibly be, because all these external factors are weighing down on companies' profit margins. So it ain't just ratios for the sake of ratios, right? So Velga's saying in some cases, that sovereign credit ratings are brought into play, and for um, when looking at IFRS bad debt calculation. So that's
Yeah.
interesting. Yeah. So
Yeah.
we talk a bit about IFRS in our training programs, don't we? So how would that
Yeah.
manifest then, Brad, if you had a sovereign credit rating and IFRS, how would that correlate?
What you'd be saying, so let's just get it up here.
Yeah, Velga's
So what
interesting point.
yeah, so what you would do on something like that is say, if it's probably, I'm going to guess, Velga, correct me if I'm wrong, it's more getting down to these speculative grades where you're thinking, what is the likelihood of that economy being unable to support a business, or that business or businesses in that economy have a fairly high sort of failure rate. So what you would have to do is to say, right, I'm in this particular country. Let's say, I don't know, I'll just pick a yellow one, Turkey, for example, or Egypt, and you're thinking, yeah, for example, across that economy, maybe I don't know, 1 in 15 businesses will fail in a certain time frame. Whereas if you go to a stronger country, that number might only be 1 in 5 or 1 in 8 of that sort of thing. So you're saying there is a high likelihood that a business will fall over, and therefore, or there will be troubles in collecting that. It could also be with IFRS. It also be the ability to collect repayments because of currency restrictions or liquidity shortfalls that might be within that country's economy. It could just be trying to get money in and out is very difficult as well.
And these do change. I was just thinking, when would it have been, in the 1970s and maybe since then? Like the UK, for example, would have gone from favorable ratings to not so favorable ratings because the UK economy really struggled in the late 70s and the early 80s, with high unemployment, high interest rates. Um, a lot of businesses were closing down, mines and shipbuilding and so on. So there's a lot of turbulence. So the UK ratings would have changed. Um, Other countries have also gone from high to low. I suppose, I don't know. I'm just thinking Argentina, for example. That's perhaps one that's been wealthy and they're not so wealthy in the not too distant past. Yeah, is there anywhere else you can think of, Brad, where the ratings have changed kind of quite dramatically in recent times?
Certainly think places like Poland, for example, have been very good in the sense that they've taken on a lot more of the manufacturing cost base out of neighboring countries like Germany and Austria. And a lot of those now, Poland is it used to be like, oh, it just came out of the out of Soviet control and so forth. But certainly certainly over the last 10 years, it's really powered on.
Yeah.
Some are even saying in the next 10 years it will probably rival the economy of Germany. Um, so yeah, but
Yeah.
yes, a lot of that happening.
It's a good example of going up, going from sort of yellow to green, rather than the other way around. Yeah.
That's right. Again,
Okay.
keep your eye on India as well. That is going to be that's going. I mean, that's almost the opposite of the world now. South Africa, sadly, seems to be going the other way,
Mm.
where it used to have quite a well-bound infrastructure. Now, because of the Ramaphosa and the ANC government coming in there,
Mhm.
there has been huge failings in infrastructure across the country.
Yeah, so it's relevant to all of us because we have to think about the countries that we're trading with, and I know, with the nature of our global business services, and many of them are literally that. I know, many of you responsibility for countries in the Middle East, in Africa, Australia, New Zealand, the Americas, even though most of us are domiciled in Europe. Um, so all these factors really do come into play when you think about the markets that you're attempting to collect from. So it's um, okay. Brad, we've only got a couple of minutes left. That hour has absolutely whizzed by. as I said at the beginning, I think we were in for a treat, and I hope you agree with me, everybody. And indeed, a record audience today, by the way. So thank you very much. We peaked at 84, which was fantastic. So we're really grateful to everybody.
Thank you.
So just yes, well, no, thank you. You've got the job now to lead these coffee clubs from here on in. So, but no, thank you. Really, I know you put an awful lot of effort into that, as you can see from the graphics, the quality of the graphics, and of course but basically the information, which was really top stuff. So Brad, absolutely brilliant. Thank you so much indeed. As we said here, we're back again in 2 weeks' time. There will be a credit clinic on April the 23rd. More information that will follow. We'll mail out to you. We're just confirming the details on that. It'll also be on LinkedIn. If you're not following us on LinkedIn yet, please do. Because that's where I say a lot of our information and regular posts all emanate largely through our LinkedIn. As I said at the beginning, this recording will be available on the Callisto membership. If you're not yet members of Callisto, because we have hundreds and hundreds of hours of learning material exclusive for our members, this will be the next one added on very soon. Please get in touch, and we'll be happy to talk to you about our membership as well. Coming up in October, just to finish off, we got our 14th Credit Matters conference. We're in Budapest. We've already got about 20 people registered from various companies and various countries. Looking forward to see more than 200 people there. Okay, so that's everything. Thank you very much. Stay in touch, everybody. Thank you all. Thanks again, Brad. In the meantime, take care, stay safe, God bless, and we'll see you all very soon. Thank you. Goodbye.
Bye.
Bye-bye.